This is Jeremy Squire for Wealth Associates Asset Management, and this is our report to investors. In this report, I want to reflect back over the last 4 years and 11 months. The first funds were invested in December 2012, and we're very proud of the fact that in October 2017, total assets under management across the 4 funds exceeded 1 billion rand for the first time. This is a remarkable achievement, and we believe it is testimony to the process, the manner in which the funds are constructed, and the consistency of performance which has been delivered to our clients. The 4 portfolios are designed to cater for the needs of all of our clients, and they range from lower risk up to higher risk portfolios, and are the cautious, the moderate, the balanced, and the growth portfolio. The cautious portfolio is a portfolio which is really geared towards an inflation plus 3% per annum return over rolling 3-year periods. This portfolio is ideal for the client who has contingency funds, which they want to retain fairly liquid and to have very low market risk, and which probably don't have any specific time horizon. The cautious fund, since inception, has attained a return above inflation. Inflation over the period has been 5.7% per annum, and it's attained a net return after portfolio costs and inflation of 3.9% per annum. So that's a gross return over the nearly 5-year period of 9.58%. Then we have the moderate portfolio, and the moderate portfolio targets inflation plus 4% per annum over rolling 5-year periods, and is ideally suited to the retired investor who receives regular income payments from their investment. The portfolio provides sustainable income flows and capital growth, and this portfolio has achieved over the nearly 5-year period an inflation-beating return of 5.3% per annum. That's a gross return of 10.95% per annum over the measured period. Then we have the balanced portfolio, and the balanced portfolio targets inflation plus 5% per annum over rolling 5-year periods, and is the ideal vehicle for pre-retirement savings for investors across the age spectrum. The balanced fund over the 5-year period has achieved a net return after inflation of 6.4% per annum and a gross return of 12.13% over the 5-year period. And then finally we've got the growth portfolio, and the growth portfolio is the highest risk portfolio, and it targets inflation plus 6% per annum over rolling 6-year periods. This portfolio is designed to give equity-like returns, but with around about 2/3 of the volatility or risk of the typical equity portfolio. And the portfolio is ideal as a satellite strategy for clients who want to have a little more risk outside of their core investment portfolios. The growth fund has achieved a return net of inflation over the 5-year period of 7.7% per annum and a gross return of 13.39% over the 5-year period. So in each instance, all of the portfolios have attained their targeted results over the 5-year period and have substantially outperformed inflation. And that inflation-beating investments are incredibly important for our investors. When we started the portfolios in December 2012, they were constructed as what's known as wrap fund portfolios. Wrap funds are a collection of different unit trusts which are put together on a LISP platform. A LISP is a linked investment services provider or a unit trust platform, and allow for a risk profiled collection of asset managers and asset types in order to achieve the risk return profile of each of the 4 funds. In July 2016, the Wealth Associates portfolios were changed from the wrap fund format into fund of fund formats, where each of the portfolios was registered as an independent fund of funds through BCI as the ManCo. The reason for this is that it offered greater flexibility, cost reduction. Portfolio metrics have been the investment advisors to the Wealth Associates Asset Management Funds since the inception and remain the advisors to date. And their work with Wealth Associates is to assist in manager selection, asset allocation, optimization of the 4 portfolios in terms of their risk return profiles, and the relationship of each fund within each asset class with one another. The graph that you'll see, it illustrates what portfolio metrics call flying information. And what it does is it illustrates how each of the 4 portfolios operate at different levels of risk and return. And very importantly, over the measured 5-year period, there's no real convergence of the one portfolio with the other. And this means that those clients who are invested in low risk portfolios can be confident that they're not going to have levels of volatility which they didn't sign up for. And by the same token, the clients in the higher risk portfolios will have greater volatility, but will also attain higher returns over time. And that's exactly what is intended in terms of having the 4 risk profile portfolios. In order to achieve this, portfolio metrics continuously optimize asset allocation and manager selection across the portfolios. This optimization gives investors confidence that they'll achieve anticipated levels of return without taking on too much or too little risk according to their stated risk profile. The portfolios are multi-asset and multi-manager portfolios and are constructed using what we call the building block approach to asset allocation. What this means is that we select specialist managers in each asset class and place much emphasis on ensuring that each manager selected is not only consistently competent, but also has differing approaches to providing the best risk-appropriate returns they can achieve. The same managers are employed in each of our 4 funds, with the lower risk portfolios having a lower allocation to higher risk growth classes and the higher risk portfolios having higher allocation of higher risk assets. The first asset class is South African equities. In this class, we employ 6 different managers. These managers are 361, Lorium, Truffle, Fairtree, Satrix Momentum, and Core Shares Dividend Aristocrats. The Satrix Momentum and Core Shares Dividend Aristocrats funds are what are known as Smart Beta Index funds. The next category is offshore equity, and here we employ the Portfolio Metrics Global Equity Fund of Funds. This is a specialist fund of funds which Portfolio Metrics construct and has many different offshore fund managers, and those fund managers complement one another in terms of giving lowest volatility with the optimized level of return. Then we have South African bonds. Here we employ 2 managers, Stanlib and Coronation. Global bonds is a sector, but we currently have no exposure to global bonds because of the returns available are deemed to be too low relative to the risks inherent in the sector. Then we have South African property. In this sector, we have Sesfakile, who are property specialists. In the global property space, we also employ Sesfakile. The last sector is South African cash and income funds, and here we employ 3 managers. These are Fairtree, Net Group Flexible Income Fund, and Coronation Strategic Income Fund. The next point I want to make is the importance of portfolio costs and the impact on investor returns. Since the inception, we have been extremely conscious of the fact that returns are impacted by excessive costs, and we make a constant attempt to negotiate down portfolio costs. Portfolio costs have been notoriously difficult for investors to use as a measure of one manager against the other. During 2016, the Financial Services Board introduced a measure called total investment costs, and this has standardized and regularized the detail which each investment manager must disclose, and has made it much more transparent and easy for investors to measure the actual costs of their portfolios. Wealth Associates Fund of Funds are amongst the lowest cost multi-manager portfolios available, and this is a significant contributor to the consistent returns net of portfolio costs which were mentioned to each of the funds relative to their inflation targets. This has been Jeremy Squire for Wealth Associates Asset Management. We wish everyone well over the upcoming holiday season and look forward to seeing everyone in a more prosperous South Africa in 2018.